House prices could inflate 30%, according to a confidential RBA report. Let's have a look. Hello everyone, Florian.heise here, and welcome to another episode of HeiseSays. Grab your stein of coffee and let's have a look at this article from the Financial Review. Low rate inflate asset prices, according to the RBA. And this article discusses, well, a confidential analysis by the Reserve Bank of Australia suggests house values could jump 30% over 3 years if borrowers believe the cut in rates is permanent. Now, the question is it going to be possible for the RBA to normalize rates? I'll bring this up. You can see our cash rate is sitting at 0.1%. Now, when the US tried to normalize rates, what happened? It didn't work. The market started to crash. Do you think there would be political will here in Australia to allow for a correction in the property market? Now, 30% growth or inflation, this is what it is, it's inflation. It's because of the Candlon effect. Refers to a change in relative prices resulting from a change in money supply. Now, with a lower cash rate, that means more people have the capacity to borrow, and that's an increase in the supply of money through property. It's the injection point. So that means property is going to get more expensive relative to other things. The purchasing power of your savings, of your deposits that you've been scraping away, is going to be less effective. That's it. Because when people borrow money, money is essentially created out of thin air by the banks. They've got the capacity to do that. We're a fractional reserve system here with the banks. They don't need to have, it's not like they're taking money from Joe Blogg's house and sticking it in yours. They've got a certain amount that they can create out of thin air. Now, I thought I'd bring up just mention another video I did 4 months ago. RBA modeling of 40% house price falls. Okay, that's what they were predicting there, everyone. 40% house price falls coming from the RBA. This is part of their modeling. So they've done it before. So we've got to realize, okay, these are not predictions. These are scenarios that they'll put forward. But the more and more I see this one, I suspect it's to do with the fact, how risky is Australian household debt? This is the report, the research discussion paper. Could this have been done for political purposes to push the government towards stimulus, towards their interventions into the economy, or as a justification for the significant cash rate cut? Remember when a 3% cash rate was considered emergency? Remember that? So, the RBA is on alert for ultra-low borrowing costs inflating a credit-fueled asset bubble, and financial regulators are ready to act if necessary. But so far, the central bank believes lending standards are prudent. Now, you've got to understand there's a traditional definition of inflation. That's when you increase the supply of money in your system. Now, the new definition of inflation is when when costs increase. And they've got quite interesting ways of measuring inflation. Remember when CPI, just a few months ago, it actually went down, or was very low, because of the savings everyone got in childcare. They had free childcare. They were giving that out left, right, and center. It's not free. We're all paying for it in the future. But that put a dent in inflation. Or when international, prices for flights go down, that saves you money on inflation. We really need two measures. One, probably the real inflation that affects normal people, and the, entire market inflation, cost of living inflation. An internal RBA document released on Friday in response to a Freedom of Information request says the biggest risk to the economy was high unemployment, and that stronger household balance sheets for low rates could help counteract the danger. While some market economists have warned that the current extremely low interest rates pose medium-term financial stability risks to the economy, on balance, the central bank saw rising asset prices as a net positive. That's what they see it, as a net positive. This is the thing, everyone. They're selling out future generations to keep everything ticking along because they're so scared of a market correction. And you need creative destruction in an economy, everyone. You need adversity, you need challenge, or else you're going to become weak. RBA staff analysis conducted in November said the $200 billion in ultra-cheap loans to commercial banks, government bonds, bond buying, and the 0.1% interest rate would assist the recovery from the COVID-19 induced recession. It's just going to perpetuate the property bubble we have even more. That's the real problem with all of this. Some people want to crash. Some people desperately need a correction in property just so they can hope to get in there. And that's quite understandable. Well, those of us that already are in the property market, you want it to go up. Unless, of course, you're trying to build an empire, just one property after the other. Well, then you want it to go up too, because then you can use the capital growth to negative gear another property and pay interest only. A rise in the price of houses and other assets, such as shares, would increase household wealth, improve household cash flow, lift consumer spending, and stimulate business investment. The bank's economist noted in an internal brief note dated the November 23rd. Now, the issue with this is it's going to be a K-shaped economy. You're going to have those people that are in the housing market that have shares that can actually reap the benefits of it. And then you have people that are probably struggling to get in the housing market that don't have shares or are not exposed to it or adverse to the risk that aren't going to reap the benefits of it. But everyone will be paying the price for it. Fantastic, isn't it? Really fair system. Looser monetary policy would also put downward pressure on the exchange rate. The analysis noted that a permanent 1 percentage point cut in the overnight cash rate would increase real house prices 30% after about 3 years, the RBA noted. Oh boy. And here first home buyer activity has increased. We've seen that. That's just the loans that have come out recently. The latest loan data, it's first home buyers going in. And if there's a 30% increase in 3 years, if this stays low, why wouldn't you? That's the thing. Hedge your bets. If the interest rate reduction was temporary, house prices would rise 10% over 3 years. RBA Governor Philip Lowe has pledged that he does not expect the 0.1% cash rate to increase for at least 3 years. And it'll be interesting to see in 3 years' time if they can pull it up above that. If it's a trap now and we're stuck at this low rate. Monetary policy appears to have larger effects in local areas in which housing supply constraints are binding, mortgage debt is higher, and there are more housing investors, the RBA economist noted. Certainly much of the credit growth is coming from owner-occupiers. First home buyer activity has increased strongly in recent months, a positive indication of access to housing for younger households according to loan commitment data. The findings are consistent with public remarks by Dr. Lowe, who has said one of the transmission mechanisms of lower interest rates is strengthening household balance sheets by boosting their cash flow and supporting asset prices to induce spending. So here we have interest rates, sensitive liabilities, and assets by age. So you've got the assets and liabilities, and you can see here, there we go, 35 to 45. It's the liabilities, so it's getting more spending in younger people. So which households pay or earn at least 20% of income as interests? Now that's interesting. So 65 plus, they earn at least 20% as interest, and just everyone else, 64, they're getting up there, 10%, and then it just gets worse. In contrast with a famous paper he co-wrote in 2002 for the Bank of International Settlements, in which Dr. Lowe warned low interest rates could fuel risky credit growth and asset price rises that may need to be counteracted by tighter monetary policy. In the recovery from the COVID-19 recession, the bank's number one goal is to reduce unemployment, which was 6.8% in November. Since 2019, the RBA has cut the cash rate by 1.4 percentage points to a record low of 0.1% in November 2020. Plus, it has unleashed a range of unconventional tools to lower borrowing costs across the economy. New monthly home lending commitments surged to a record $24 billion in November as buyers seized on ultra-low borrowing costs and bet on a sustained recovery in residential property prices. Australian capital city dwellings prices rose 2% through 2020, according to CoreLogic. After falling in the middle of the year, capital city house prices rebounded strongly in the last few months as ultra-low interest rates and an improved economic outlook bolstered the residential property market. Over the 12 months, Sydney prices gained 2.7%, Melbourne lost 1.3%, Brisbane increased 1.1%, Perth rose 1.9%, Adelaide grew 5.9%, Hobart advanced 6.1%, Darwin jumped 9%, and Canberra was up 7.5%. And this is in our first recession in 28 years. Economists and property market analysts are tipping solid growth in house prices this year. The central bank acknowledged some risk may increase due to low interest rates. High unemployment is the biggest risk to the economy. Balance sheets and medium-term financial and macro stability and lower interest rates can help reduce this risk. Unless there is evidence of a sharp jump in credit growth and risky lending, which it does not presently see, the RBA is relatively comfortable with rising house prices. New lending for loan to valuation ratios above 85% had recently risen, but was well below pre-2015 levels when financial regulators imposed lending restrictions on interest-only loans and investor loans to cool fast credit growth and steep jump in house prices. If price rises induce large amounts of new property construction, this can create an overhang of excess supply, causing further price falls, the RBA said. More of the loan book will be borrowers who bought near the price peak, as new property purchases tend to increase during booms. Means more of the loan book is likely to be negative equity. Australian financial regulators will monitor and control risk. The Council of Financial Regulators will act if necessary, so tighter lending standards. Since 2015, standards tightened substantially for both housing and commercial property. APRA and ASIC have both taken steps to reinforce sound lending for residential mortgages in particular. It noted the Reserve Bank of New South Wales, which is combating a surge in house prices, was planning to reinstate high LVR lending restrictions in March 2021. Well, my understanding is some house prices in NZ have gone up 20%. It's just growing crazy. The NZ viewers are telling us how it's going nuts over there. So, on the distributional impact of ultra-low rates, the RBA said over the past 5 years, household financial income from interest, dividends, and superannuation had grown well below long-range averages, mainly reflecting lower interest rates. Higher income and older households are likely to have been most affected because they receive a large share of their income from these sources, so a hit for retirees. On the downside, this had hurt retirees because interest income is a more important source of income for older households relative to younger, and people aged over 55 are recipients of about 2/3 of total interest income across the population. Well, yes, true, but if you're at that level and you own a house, just sell it for a mozza. Maybe they have, and they don't want to draw down on that interest income, but the RBA, they want you to spend it. They want you to spend the money. Households reliant on interest income are now required to draw down more of their savings than in the past to maintain the same cash flow, the RBA noted. However, there were also upsides for household income from low rates, boosting asset prices and creating a stronger economy. Net savers, including self-funded retirees, received significant indirect benefits through stronger economic conditions and higher asset prices. Housing accounts for around half of the wealth of households in 65 plus. Monetary stimulus supports employment. For younger savers, unemployment has a far greater effect on income than lower rates. First-home buyer commitments have increased, which is a positive sign for younger households. Low rates are also supporting government borrowing and subsequently the economic recovery. The government has also cut deeming rates for the age pension to protect the amount pensioners received. I still don't get deeming rates, guys. Why don't they just have... Is it so pensioners don't need to report their income? Shouldn't they just report it? Explain to me why. Are they trying to make it... I'm assuming they're trying to make it simpler for pensioners, or the government wants to pay less. That's what I'm thinking. It's one of those two reasons. Retiree advocacy groups argue that current deeming rates are still too high given the current level of the cash rate and could push retirees to consider riskier investments like equities, the RBA noted. So there we have it, everyone. Going from 4 months ago modelling of a 40% fall in house prices to now predicting or modelling a potential 30% increase over the next 3 years. and the RBA isn't worried about it. They're not worried about it. What do you think? Everyone? Do they instill you with confidence? Do you like the fact that we're in a system here where, well, our lives are influenced so much by the board, the real board? As always, let me know your thoughts and opinions in the comments down below. Do you expect to see a 30% increase materialize? What would that do to your property or your hopes of getting into property? I mean, that'd be nuts if that happened here in Brisbane. It'd be crazy. We'd be approaching prices closer to Sydney. Anyway, guys, thanks for watching. Please like, share, and subscribe to the channel. If you're a fan and want to support the content I create here, there are a few ways you can. You can join us on YouTube or Patreon. You can support us using our affiliate links from Amazon, eBay, Independent Reserve, or AussieBroadband. You can buy merch from HeiseSays, use Gold Pass from the Perth Mint, or support us via PayPal. Take care, everyone, and I will see you all next time. Bye for now.